The stock market is designed to transfer money from the active to the patient. Truer words have never been spoken by one of the legendary Warren Buffett, and it's not surprising that his long-term partner, Charlie Munger, believes that ordinary investors can use patience and discipline to grow wealth, even when starting with modest amounts of money. But how can ordinary folks with limited capital be patient in the right way, and with a small amount to build wealth over time? If you're like me, you've probably found investing to be overwhelming at times. Watching the markets fluctuate day to day can feel like a roller coaster, and trying to pick the best stocks with little money to start with can seem downright futile. Believe me, I've been there too. When I first started out, I had less than $2,000 to my name. The idea of turning that into any substantial sum felt impossible. But what if I told you it doesn't have to be that way? In fact, some of the most famous investors in history, like Warren Buffett, began with surprisingly modest amounts. Buffett purchased his first stock at just 11 years old in 1942, putting about $115 of savings into Citi Service Preferred, and Charlie Munger started his partnership in the 1960s with less than $15,000. Their rise to success was never smooth nor linear, but by channeling wisdom into patience and discipline, they compounded knowledge and capital into staggering fortunes over lifetimes. Welcome to MoneyWise Investor, your trusted source for financial information. And in today's video, we'll be diving into Munger's timeless principles on how ordinary folks can effectively invest small amounts of money from the ground up. So whether you're just starting out or looking to maximize returns, this is the perfect video for you. If you're ready to begin your journey towards financial freedom, hit that subscribe button and make sure notifications are on. The strategies I'm about to show you are the exact same ones used by the ultra-wealthy to catapult past the competition. Alright, first things first. What does Charlie Munger have to say about investing small amounts of money? Well, during Berkshire Hathaway's annual shareholder meeting in 2003, Munger was asked what investment advice he would give to an ordinary investor with just $10,000 to their name. Here's how he responded. I would do little, except find some wonderful businesses like Berkshire Hathaway, where all I had to do was write a very small check every year and spend an hour or so reading the annual report. And if there were more managers like Warren Buffett and more businesses like Berkshire, ordinary investors could do a great deal better than they do. Now this is a really interesting perspective coming from Munger. Despite having grown his fortune to billions, he advocates that small investors should keep things simple by finding a great company and holding on to it long term, rather than getting caught up in speculative trading. And in another interview, Munger also emphasized the power of patience and discipline for the small investor. When asked what's the most important quality an investor should have, here's what he said. The most important quality is temperament. Having a temperament that neither derives great pleasure from being with the crowd or against the crowd. Having your own separate quantitative judgments and having patience. Munger highlights that avoiding the herd mentality and sticking steadfastly to your own analysis is key. This means tuning out all of the noise and short-term irrationality in the market. Warren Buffett echoes this sentiment about the remarkable power of compound interest over time for the patient, small investor, as he puts it. My wealth has come from a combination of living in America, some lucky genes, and compound interest. Now this is coming from a guy who started off his investing journey with less than $10,000 in the 1950s and is now worth over $100 billion. So both Buffett and Munger's advice boils down to this: having a long investment horizon, block out the outside noise, and let the uncompounded magic of patience and discipline grow your money over decades. Okay, so with that context of Buffett and Munger's overarching philosophy, let's get into the specific ways a small investor can put their money to work intelligently. Number 1. Look in the inefficient markets. Now, at first glance, this might seem confusing. Inefficient markets? What does Munger mean here? Well, certain areas of the stock market are very efficient. Prices instantly reflect new information about the major stocks. This makes it tough for small individual investors to gain an edge. But Munger encourages looking beyond this realm, into less followed niches where critical information isn't always accounted for in share prices. As Munger puts it, you have to turn over a lot of rocks to find places no one else has found. This begs the question, what are inefficient markets? Well, these are areas of investing where there isn't a ton of competition and information isn't widely disseminated. This creates pockets of opportunity for diligent investors who are willing to put in the research legwork. Some examples include small cap stocks, companies undergoing restructuring, spin-offs, or even local real estate deals. The point is to target investments that the mainstream and institutional investors aren't focusing on. Let's say you come across a small $50 million company that's trading at a low valuation multiple, has good management, and operates in a steady niche industry. It might not be a big sweet stock that grabs headlines, but for a small investor, it could result in highly favorable returns over time. Buffett has repeatedly emphasized that the best bargains often come from businesses that are good but not great. These companies tend to fly under the radar, but the patient, observant small investor can spot the diamonds in the rough. In fact, this is exactly how Warren Buffett generated huge returns early on. He extensively researched smaller OTC companies that many dismissed at the time. When Buffett identified a high-quality business trading far below its worth, he would make a killing buying in before others caught on. The key is not making it more complicated than it needs to be. As Munger puts it, it's not supposed to be easy. Anyone who finds it easy is stupid. But with focus and determination, hidden gems are waiting for those willing to uncover them. Okay, let's move on to Munger's advice around taking big swings when you get a great pitch. Now at first, this might seem counterintuitive. Shouldn't you play it safe and diversify when funds are tight? Well, as Munger puts it, if you can spot your best opportunities with clarity, it's foolish not to bet big on them. Even starting out with modest capital, swing for the fences when the data is clearly in your favor. Munger knows how to balance steady compounding with the occasional big bet. When asked about this, Munger said, "If you're going to try and outperform the market, you have very few positions that are substantially better than average. No one ever made it really big by plodding along." Look at how this played out for Warren Buffett back in the 1960s. At the time, his partnership had less than $10 million under management. But when Buffett identified Disney as drastically underpriced, he invested over 25% of the entire portfolio into it. It took tremendous conviction and discipline to make such a concentrated bet, but over the following decade, Disney stock appreciated over 4,000%, turning that single shrewd move into a game-changing windfall. Munger wants small individual investors to think big picture like this too. Don't just nibble around the edges on mediocre ideas. Be willing to take larger positions when you have a truly exceptional opportunity in your sights. Hold enough cash so you can go all in when the stars align. Even if you only do this a handful of times over your lifetime, the exponential impact can be life-changing. Of course, this requires humility and rational thinking to avoid foolish risks. Only swing big when the data truly aligns with the principles of investing greats like Munger. But when it does, be ready to step up to the plate and knock it out of the park. A few home runs can make up for a lot of strikeouts when playing the long game. This leads nicely into our third strategy, which is, don't be afraid of a concentrated portfolio. Many typical investment advisors advocate extensive diversification, and this makes sense for big institutional investors managing billions of dollars. Piggybacking off the last point, Munger is a huge proponent of portfolio concentration, even for small investors just starting out. As he puts it, diversification for its own sake makes no sense if you have limited capital. Here's a quick thought experiment to illustrate his viewpoint. Imagine you have $5,000 to invest. If you spread it evenly across 20 stocks, you're only allocating $250 to each position. But what if you only had one or two high-conviction picks? Investing so little into each provides almost no room for meaningful gains. You'd be much better off taking 80 or 90% of that capital and deploying it into your number one idea. If your research is right, your returns will be exponentially higher. This is why Buffett has said if he was starting over with limited capital, he would take his 10 best ideas and put 50% of his money in his top 2 picks, 30% in his third and fourth idea, and 10% in the rest. Going big on your highest confidence bets amplifies returns. And Munger applies similar concentrated value investing thinking even to small portfolios. Don't diversify yourself into mediocrity out of textbook theory. Focus on your best 1 or 2 swings and step up to the plate aggressively when the odds are in your favor. Now, these principles certainly require patience and discipline to stick with for the long haul, but by challenging Munger's wisdom into your own investment strategy, the payoff over decades can be incredible. Never forget, Warren Buffett began with less than $1,000 as a child. Charlie Munger started his partnership with a few thousand, and their combined fortunes today are over $150 billion. Their rise to the top was never smooth or linear, but by sticking to timeless principles and playing the long game, they compounded knowledge and capital into empires. And so can you. If you found value in this video, please like, subscribe, and click the notification bell. And until next time, stay money-wise.